Already, so the recording is started. We will be posting the recording as well as a copy of the slide deck to our website, which is shpllc.com/webinars, and that should be later today. Already, that takes care of all the housekeeping. Mike, the floor is yours.
All right. Well, welcome everybody. I can tell you one thing that we're not going to do again is have one of these on the very day that the portal opens. These slides, the ink isn't even dry yet, so we'll bust through what we know here. Go clip down the next couple of slides there, Aaron. All right. First thing, and this is not new, at least I hope it's not new. I talked to yet another provider as late as yesterday who was unaware that this was going on. So y'all please stay leery of the fact that the reporting for funds received during the second quarter of 20 is due now. Now, granted, going to that second bullet point there, HHS did announce a reporting grace period. So it's officially still September the 30th. However, they're not going to have recoupments or initiate enforcement actions or anything like that for any kind of non-compliance unless you haven't filed by November the 30th. And so that's very helpful. I know several of y'all are pulling the information together and kind of on the 5-yard line, but haven't put it in on the portal yet. So anyway, that's it for that. But there's a lot more stuff that has happened recently. So next slide. Okay, so we had mentioned last time, or maybe 2 forums ago, that HHS had announced that over the next several weeks, when we were talking back in August, that they were going to come up with the methodology to distribute the remaining money from the CARES Act and then the $8.5 billion from the American Rescue Plan that was several months ago. And so they now have issued some of the rules around that, some of the methodology, and they have opened the portal as of, I guess, a couple of hours ago now. And so the application cycle begins right now, and applications have to be turned in by October 26th. And so basically we have 4 weeks to get all this information in. And so you see the link there, and Kelly will walk through some more details to that over the next, down in the several slides from now. But you should have an active account going for that. That's the same portal that you were using for the attestations previously on the previous phases of provider relief funding that came out before. And so there's one portal for both of these 2 programs that is open now. And so you'll be accessing the same thing for it. Next slide. Okay, to get into the first of those 2, it's called phase 4. As you recall, we had phase 1 was the original 6.5% of Medicare. Phase 2 was the one that got the difference between that and 2% of your top line, your total revenue. Phase 3 was the one that there was an application portal open for back in November of 20, and we'll talk more about that one in just a second. There were other phases that were not general, but this is now phase 4, the general distribution. So so this one again is $17 billion. It's going to be in 2 chunks. Part of it's based on the change in operating revenue and expenses from July 1, 20 through 3/31/21, and I'll talk a little bit more about that in just a second. But it's pointed toward you see the bolded part there that it is to reimburse smaller providers disproportionately for their changes in revenues and expenditures at a higher percentage than larger. And you're about to ask, what are all the details of that? I'm gonna tell you what we have on it, but they're obviously going to take whatever the final answer and then mush it into the amount of money that they have to spend. And so they didn't issue final percentages, and you're not going to walk away from this call knowing that you've got $2 million coming. That's not the way it's working. They're giving you the general parameters, and then they're going to determine what they have to spend. They're going to back into it. So that's the first part of it. The second part of it is there's going to be bonus payments based on the amount of services that providers provided to Medicaid, CHIP, Medicare payments by repricing the CHIP and Medicaid stuff higher to the Medicare rates. Next slide. So, and to delve into that a little bit deeper, it's the first section that's lost revenue and expense based is 75% of the allocation. And the three chunks of providers, and again, they haven't defined who's a large, who's a medium, and who's a small provider in all this. And so that is undoubtedly going to come as they segregate into the hunks of payments they're going to make within the budget they have to spend. But large providers will receive a minimum payment amount based on the percentage of their change in operating revenues and expenses over that nine-month period. And what it appears to be is that it's third and fourth quarter of 20 and first quarter of 21 as compared to the applicable quarter of 19. So it's third and fourth quarter of 20, 20 versus 19, and then first quarter of 21 versus the first quarter of 19 would be where the change is coming from. Medium and small providers receive a base payment plus a supplement, with the small providers again being an inversely proportional higher supplement. And again, no numbers around that, just the statement that that's going to be their methodology. And again, the exact amount will come later on. Nobody's going to get more than 100% of what they lost. That kind of seems obvious, but they noted that as well. Next slide. The other fourth of the phase 4 money is going to be based, what appears to be strictly based on the pricing of Medicaid and CHIP data to reprice at Medicare. This one, you're not going to submit any data for it. They're going to take the data that the feds already have for that. They accumulated it in all the prior rounds, and that they would be repricing it, and that would be the amount. Now, that said, again, that's going to be put in the pool, and then they're going to down that to the amount of money that they actually have to spend. And so you're not going to, again, we don't have a defined number for that right now. A couple of questions that I still have for this is that, like Georgia, for you hospitals that are on the phone, Georgia is a cost-based state. And so Medicaid, and a lot of times with you guys, pays higher than Medicare. Does that mean there's no additional reimbursement for that? Will that mean it'll take away from the dollars on the other side? That hasn't been published yet. And then there's a thought in there that services that are predominantly provided to Medicaid would be excluded from the repricing. Again, we kind of went through the rounds last time where like providers like pediatricians, OB, some of the community service boards were harmed in the process or not helped near as much in the process because of those definitions, and not being, because they provided a lot more Medicaid and a lot less Medicare business. And so I hope we're not in that same position again, but we need to continue to follow it, obviously, very actively. Next slide, please. All right, this eye chart here, I won't get into all of the detail of this, but it's split between the base payment. Phase 4 is going to be split between the base payment and the bonus payment, like I was talking about. The base payment is the percentage of the change in the quarterly operating revenues and expenses. And what it looks like is it's not a quarterly thing the way your HHS reporting has been. It's the entire 9-month period versus the prior period. And so you'll have the comparison of the 3 quarters versus the 3 quarters, and then it'll be times whatever is the percentage that they come up with. In phase 3, that was 88%, but whatever percentage they come up with for what portion of that, either lost revenue or increased expense, whatever that would be, whatever, they'll come up with the percentage later on for what of that they will reimburse you. And then from all of that, they're going to deduct the prior provider relief payments, i.e. for those who either got nothing previously or very small amounts previously, a lot of the same types of providers, community service board, pediatricians, OB, that they would be helped more in this round because they've gotten a lot less in the prior rounds. Next slide. In relation to the bonus payments themselves, that's the other 25% of phase 4. Again, the red part there is that you will submit no data related to that. HRSA and HHS are going to take the Medicare, Medicaid data they already have. They're going to reprice Medicaid CHIP claims up to Medicare rates to promote the equity for those types of providers. And then there are some machinations about how that's going to go, but basically that's the the repricing your Medicaid and CHIP volume up to Medicare is where the vast majority of the bonus payment is going to come from. All right, next slide. Who's eligible to apply for phase 4? Almost everybody is what it feels like. Anybody who's provided any services to a Medicaid program, to a Medicare program, whether or not it's the traditional Medicare, Medicaid program, or the, in our state, the CMOs and the Medicare Advantage plans, that any of that applies to it. You could be a dental service provider, an assisted living facility, or a behavioral health provider as well. And so, and then you should have also received a targeted distribution payment, or that you would qualify if you received targeted distribution payment before. You either had to have filed tax returns for 18, 19, and 20, or be exempt from that, provide care after 13120. You couldn't have closed, and then whether or not you're an individual that provided care, gross receipts that were reported on a 1040 previously if you don't have a corporate return. Next slide. All right, so shifting over from the phase 4 general distribution onto the American Rescue Plan rural program. This one is overlaps methodology-wise with some of the phase 4 stuff, but it is specific, obviously, to rural providers. One huge point about this is that if you happen to be not in a rural area, it is not based on where you are, it's based on where the location of your patients are. Now, presumably, that's going to mean that only the volume that you had in the locations that apply will be applicable, with an exception like critical access hospitals that I'm about to talk about in just a second. But nonetheless, you don't have to do the verification of whether or not you're in an area or whether or not your patient was in an area. They're going to do all that for you and then take that volume and reprice it, similar to what we're just talking about. But I'll show you that again in just a second. HRSA is going to be the one administrating this program. They're going to base the payments on what it already has, and same as what I was saying before, Medicaid, Medicare, and CHIP services are what they're going to base it on. And then you'll see down at the bottom, if you want to go to that link when we post it, they're using the Rural Health Grant Eligibility Analyzer to determine the areas of the country that are considered to be rural by HRSA. And it gets all the way down to census tract level. And so it's mostly a whole county is in or out, but it is address based, not whole county based. And again, that is to be applied to where the patient is from, not where not the location of the provider. Next slide, Aaron. So who's eligible for those? So you either have to be a rural health clinic. So it doesn't matter where you are if you're a rural health clinic. You're located in a rural area. You are a critical access hospital, which we would clarify that the critical access hospitals are automatically in, or you're a provider that has, again, similar range of services, that you've provided services to Medicare fee-for-service program, Medicare Advantage program, Medicaid fee-for-service program, CHIP program, and that you operate in the non-metro counties, census tracts. You see those definitions of the rural areas, again, that is applicable to the patients, not necessarily to the location of the provider. Next slide. Very similar to the phase 4 methodology, HHS will make the payments, or HRSA in this case, sorry, will make the payments to providers based on the amount and type, Medicare, Medicaid, and CHIP services. And again, basically, it'll be the repricing of the Medicaid to the Medicare rates. However, their providers that are in the rural area will receive a minimum payment down that last bullet there. Next slide. And then same thing. How will those be calculated? Basically, they're going to reprice Medicaid to Medicare rates, and then adjust for the type of provider that you are, and then adjust based on the total $8.5 billion that they have to spend in the first place. Next slide. I'm going to turn it over to Kelly to walk through the next several slides that kind of get into the details of the application rules and some information about the portal. Kelly.
Great, thanks. So a couple sort of baseline rules that HRSA has announced for this next application cycle. As Mike had shared previously, despite the fact that the funding is segmented into 2 distributions, they're using a single application. And the expectation is that if there's a parent company with multiple subsidiaries, that it will be the parent company who will be filing one application on behalf of themselves and their subsidiaries. That if multiple applications are submitted by TIN, HRSA will not pay duplicate providers, and it may impact the processing of any of the applications submitted. And again, if you are entity with a parent, TIN, and multiple subsidiaries, they all must be represented on the application that you submit. So next slide. This is iChart. So this is sort of the flow chart that HRSA had released this morning in terms of the steps of considering whether to apply. And to state, we think that everybody should apply for this round of funding, to ensure that you receive the money allocated, but determine if you're an eligible organization, to gather the documents and the information that you need. We'll touch on that in the next slide. To submit your organization's TIN for IRS validation. Now, as Mike had shared, they are using the same portal that they used for the phase 3 application as well as your attestations. But if you have not ever created a login to attest to a previous payment, or you did not apply for phase 3 funding, you will have to do the IRS validation portion of this process. And that can take up to 10 days. Since the application cycle is open only about 30 days, it will be critical, if you have never logged in to create an application, that you do that as soon as possible to ensure that your TIN is validated and you can complete the application prior to that October 26th deadline. Once you receive the email confirmation, if you are just now applying for that validation, you can go ahead and start your application. Upload all of your supporting documents, as we'll talk about a little bit later, tax documents, and in some cases, additional worksheets will need to be uploaded. Deadline is October 26th at 11:59 p.m. Eastern Standard Time. The application has to be completed and submitted by then. HRSA will review the application, calculate it based on their total number of applications, and then we'll update you on whether or not a payment is received, and they will make that payment via electronic funds transfer. One thing to note is that HRSA has not put a timeline on when the application cycle closes to when they anticipate making those first distributions. That part is still up in the air. Next slide. So the sample application form, this should look really familiar to any of our entities that did a phase 3 general distribution application. The first part is really your basic entity parameters that you'll input: contact information, your TIN information, address information. Next slide. And then, as Mike talked about, they are going to be looking for revenue input here. And the periods get a little goofy because Q2 is taken out of every year, because that's what was really used for previous distributions. So they're going to be looking for 2019, your Q1, Q3, and Q4. And then for 2020, Q3 and Q4, as well as Q1 of 2021 data to be input, both your operating revenues and your operating expenses from patient care. Next slide. And then this is the supporting documentation. And so for certain providers, dependent on the actual revenue submission, there will be an annual revenue worksheet and expense worksheet that will need to be uploaded, as well as your tax documentation. And then, as you guys can see from the red arrow, this is where you would throw your hat into the ring to be considered for the ARP rural distribution. And again, since it will be based on where the patients are located, not where the provider is located, we really think that this should be a yes for everybody to be considered for that funding, as HRSA will automatically pull the data based on your Medicare, Medicaid, and CHIP submissions.
Hey,
And
Kel,
yeah. Yes.
we have a question. Can you repeat the applicable quarters?
Yes. So 2019, Q1, Q3, and Q4. 2020 is Q3 and Q4. And 2021 is Q1.
Thank you.
And then the last piece of information will be to input your banking information. As I shared, HRSA will be making these payments electronically. So registering your banking information for them to distribute that payment once they're completed with the calculations. Next slide. So in terms of the documentation, as we touched on, tax returns will need to be submitted, as well as any internally generated financial statements substantiating operating revenues and expenses from the quarters that we discussed. For the tax return information, on the next slide, HRSA further clarified by entity type what documentation they're looking for. So Aaron, can you flip on to the next slide? And so again, this should look very familiar, you know, depending on what entity type you are. HRSA has indicated the relevant information. For entities that are not required to file federal income taxes, they will accept an internally generated financial statement, as well as a statement explaining why the entity is not required to file a federal tax form. Next slide. Lastly, HRSA has announced, and we've included the registration links here for technical webcast on this round of funding. And so they'll be hosting the first one tomorrow, and then their second version will be next Tuesday. So encourage registration for those as well for additional information. Next slide. I'm going to turn this section back over to Mike.
All right. So for those of y'all who, when the phase 3 came out, it required a portal input. And then from your perspective, it either dropped into a black hole or you got a tiny payment. You really had no idea what happened. And the feds had never issued the rules for it. They're issuing the rules and the methodology that they went through is for you to recalculate what you should have gotten, and B, they're in the process of developing a portal or an input mechanism for you to appeal that answer and do something about it. And so I know one huge point about this is that many of y'all didn't apply for phase 3 money, and so if you didn't apply way back when, it's based on only on those who did try. And so there is, you know, that may have just lost half my audience here, but it is for people who did apply and want to have a reconsideration done. So that said, let's move on to that next slide. As I was saying before, they're developing a structured process to walk back through that. And with the slides I'm about to go through, if you ultimately go back through the calculation and believe that your payment was incorrect, too low, what have you, then you'll contact that PRF reconsiderations at HRSA website there in order to initiate. Next slide. Okay, here's the methodology for phase 3. There are some exceptions to this, but the basic methodology was, at that time, you were asked to put in your first 2 quarters of 2020 information versus the same quarters in 21, losses in revenue and net of the change of your expenses. And so it was their ending number was, they were attempting to pay you the greater of the 2% that you would have gotten from one of the previous rounds, or 88% of the loss. And so the way the methodology worked, it would have been the greater of those 2 numbers minus the prior, the general phase 1 and phase 2 monies that you got. And if, in theory, whatever was left over was what the phase 3 payment should have been. Next slide. To kind of walk this through in a little bit more detail, and again, I'll keep it quick because I don't think this applies to too many of y'all. It's the way it would work is you calculate the 2% of your top line. If y'all remember that was, if it's a physician practice, it's basically all patient care revenue, including, work RVU deals and all those kinds of things, even that the 2% of the top line, and then whatever you came up with as the loss from the 2 quarters, there's 2 steps that can cap it in there, and then it's 88% of that number. And so it's the higher of your 88% of the losses versus the 2% as potentially capped, and I'll talk about that in just a second. Take out all the prior provider relief funds, and then whatever was left over should have been the payment. 27, next slide. So this one, straightforward, and there was a bunch of FAQ that we went over in the past related to this, but it's basically just, at the end of the day, the 2% is just what it says. The annual patient care revenue times 0.02 to calculate that portion of it. Next slide. The loss ratio was, again, it's those first and second quarter revenues minus expenses, 20 versus the same 2 quarters in 19. And that ended up producing a loss ratio that you were dividing that by to convert it to a percentage. But at the end of the day, it really was the dollar value of lost revenue over the change in expenses. That dollar amount times 88% was the comparison number that was compared to the 2% annual revenues that you had, with a couple of exceptions that we're about to note. Next slide. The exceptions were, if you showed a single quarter revenue or expense that was more than 50%, it was off more than 50%, then they had a methodology to adjust it to just the mean loss ratio, that the average loss ratio that provider type had for the period. Or if the ultimate loss ratio was greater than 1 standard deviation off of the mean, then they had an adjustment to multiply it back to just that, the average of those that were 1 standard deviation off, rather than the full amount to cap it. And then if it was a new provider, then it gave a methodology to use a median loss ratio for that provider type, not theirs in particular, but an average for that provider type, to just use that. Then pharmacy and DME were capped at 10% straight away. Next slide. Now, to kind of tell you that last slide was a little bit irrelevant, the vast majority of folks who applied for phase 3, none of that applied to them. So the first one about it being greater than 50% off was less than 8% of the applicants. The ones that were off by more than a standard deviation were around 9%. And so the vast majority of folks, the answer is basically still 2% of your annual revenue versus 88% of the lost revenue minus the expenses. So that's that for the vast majority of y'all. That's what the answer should have been, and that's what you're going to compare to what you're minus the PRF payment. that's what you're going to compare your phase 3 payment to in the first place. Again, I get this is kind of complicated, and if y'all want to talk to us offline, we would be glad to walk through this with you individually. Next slide. And again, just kind of finishing up the mechanics of the calculation. Take the greater of A or D. A is 2%. D is the 88% of the losses as through those potentially capped. Then you take out all of the PRF payments. If the PRF payments already had reimbursed you more than that, they weren't going to pay you anymore. So the answer was 0, and that applied to about a third of the applicants at that point. But then everybody else should have gotten something. And again, a lot of y'all didn't, and so it's probably worth, if you went through this exercise way back in November, it's going to be worth it to walk back through it now. Next slide. Then there's a little process for manually flagged issues that shouldn't apply to very many of y'all at all. Next slide. I think that would have been it. A couple of questions that we had come in. What date would the payments have been sent? I think you're talking about phase 3 payments. And crazy enough, we had providers who got payments. The portal opened in November, and those who submitted very quickly, there were payments that were as fast as end of December or January. And then the last of the payments that I was aware of that came out were, you know what, Kelly, in August, July, August timeframe, we've still seen some payments come in.
That's right. It was really recent.
And so, you know, again, if you did apply way back when and have gotten nothing, then I would suggest walking through the calculation. Then the other question was, if we received a phase 3 payment, do we qualify for phase 4? Absolutely. Yes, there's no previous, matter of fact, if you qualified for phase 3, that's a trigger that you would have been qualified for phase 4. And so, yes. And again, we kind of take off our mechanical hat and put on our consulting hat just for a second. In our mind, given the broader definition of expenses on the reporting side, and the presumption that I think is accurate that they're going to use a similar methodology, I wouldn't overthink whether or not to apply now. I think I'll put it this way: if you get the money now, I would strongly suggest that you'll be able to keep it later on with the broader definition of applicable salaries at this point.
Hey, Mike, I think there was one other question. For those who were reporting this week, they've supplied all the financial data that's also being requested here. Do we need to repeat this data, and will they tie our new submission to our phase 1 report? There's no crossover between the reporting portal and the application portal. So if you want to apply for phase 4 in the rural distribution, this separate application will have to be submitted.
Yeah, and Richard, that's a great question. I meant to say that earlier. Oddly enough, it is very similar data to the HHS reporting that you're doing currently. Yes, it definitely repeats 3 of the same quarters in the same data set that's required. It, as Kelly just said, it is for 2 different purposes, and the fact that that data is being used to justify past monies versus also being used as the basis for how they're going to distribute these monies, I can't tell you why that's the case, but I know that it is the case. And so please, yes, replicate that information in the new portal and apply.
Because as a reminder, for all of the PRF distributions, particularly these later ones, the deadline for using the funds is not until December 31st of 2022. We all know that COVID is still impacting providers, so there is more than a year's worth of time left to justify funding that is received in this time period.
Outstanding point. I meant to say that earlier. So yeah, I wouldn't be gun shy. I mean, you can, if you choose to, and things are great, you can make a decision later on. There will be a mechanism to refund it later on. However, you don't have that option if you don't apply now. And this is not one of the rounds that's going to come without prompting from the providers. This is going to be like phase 3. If you don't apply for it, you're not going to get it.
So we had one other question come in about terms and conditions on keeping the funds. And so, yes, similar to all of the previous distributions, the ways that they're calculating these funds is that you're using them to prepare, prevent for, and respond to coronavirus, and that it's used for lost revenue and expenses tied to that overarching condition. And similarly, that you can't sort of double dip on justifying the funds, that each one has to be uniquely justified.
Okay. Well, I don't see any more questions in the chat. If y'all do have any, we're here for you. And so please contact us and we'll be glad to walk through whatever we can. Okay, Aaron, back to you, buddy.
Alrighty. Well, that wraps it up for today. We give you 20 minutes back to your day. But again, we will be posting a copy of the slides and the recording to our website, which is shpllc.com/webinars. I've also put links to that, as well as the Rural Health Grants Eligibility Analyzer tool and the webcasts for HRSA that are coming up here tomorrow and then next week on October 5th. There's links to all that in the chat. If you wish to grab that, this is a great opportunity to grab that now. We will also be including that in the slide deck when we post it to our website later today. Alrighty, if there's no more questions and I don't see anything else, everybody have a wonderful day.
Thank y'all. Bye.